This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from three Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, Portfolio Managers at PWL Capital, and Mark McGrath, Associate Portfolio Manager at PWL Capital.
Welcome to episode 315. Very exciting time. This is our first interview where it's the three of us.
That's right.
So Mark,
I was worried that it might be too much, but I think it's good.
Yeah, I think it was fine.
It was fine. It was great, actually. So we welcome back to the podcast Eduardo Repetto from Avantis, which people know Avantis. I'm sure many listeners are aware of Avantis. So he came and joined us to give us an update on what's going on there. I guess you've been talking to Eduardo lately, Ben?
Yeah. Well, they've been working on some stuff, which we talk about with them in the episode. And so I chatted to him and his team a little bit about what they were doing, and through those chats, we decided it'd be cool to have them come on and talk about what they're working on.
I think it was this week they broke through 50 billion, right? I saw the announcement on Twitter, so it's a pretty meaningful milestone.
Big stuff happening. Pretty cool.
Then we'll go to the Aftershow. We're going to talk about this incredible small cap rally that happened in the past week. At most, it's been incredible. This gets back to you got to be in your seat to capture the returns. It was wild, just wild.
Yeah, it has been wild. We'll talk a little bit about putting that in some historical context. It's not a huge segment on small cap value performance, but it's I think it's interesting, and it fits with the theme of having Edoardo on to talk about their strategies, which largely focus on small cap value, or at least value.
And before we get to the episode, I think Mark, you wanted to talk about stuff that's going on with the advisors lately.
Yeah, no, I just thought it was really interesting. So the episode we did, episode 313, that we did on when someone should hire a financial advisor. We got a ton of great feedback on that, and one investor in particular was really hesitant about hiring an advisor. We had considered us in the past, but was really hesitant about it, and listened to that episode and said that was sort of I think in their words, the tap that they needed on the shoulder to move forward. So they were kind of humming and hawing about whether they wanted to work with a firm like ours. And after listening to that episode, and I think resonating with some of the discussion points that we covered, it was enough to kind of push them over and say, okay, now's the time to hire advice. So just found it really interesting.
That wasn't the only story like that. I know the one you're talking about, but there were a few. I also found it really interesting. I'm always a little nervous. Listeners have heard me say this before, talking about why someone should hire an advisor, because it feels like a sales pitch. Yeah. Like I feel like I'm making a sales pitch because that's obviously what we do. Yeah. Although we've gotten the feedback that it doesn't come across that way. But anyway, I'm always nervous about talking about that. Like, why should you hire us? But it was interesting that a bunch of people reached out after that episode. But I mean, the way we laid it out, I think it just makes sense. So it therefore makes sense that people would reach out after listening to it.
But I think we'd also covered a lot about maybe just inversely when it doesn't make sense to hire. Like it didn't feel really salesy to me. Like you did a ton of research, obviously, went through a number of papers and some academic work on the topic, and it was, I think, less of a sales pitch and more of a like, you don't need an advisor until, and that's the way that I kind of saw it. But it was great. We got really good feedback and was happy to hear it.
It's fine. I don't have the same visceral reaction as you guys around selling. I don't see that as a bad thing. Yeah. Just helping people make good decisions is really what we're all about, right? So
that's true.
Yeah. And it's not like we have a product per se. Like you're going to a car dealership, their bias to sell you that brand of car. That's not the way we operate. Anything else in this intro?
I think that's good. I think we can go into the main episode and introduce Eduardo.
Okay, Ben. Eduardo is here today. Why don't you do the setup since this was your idea?
Okay, sure. So Eduardo is the Chief Investment Officer of Avantis Investors. He directs the research, design, and implementation of Avantis investment strategies, and he provides oversight of the investment team and the firm's marketing initiatives and interacting with clients. He was previously the co-CEO and co-CIO at Dimensional Fund Advisors until 2017, when he departed and then eventually kicked off Avantis.
Man, time flies, doesn't it?
It sure does.
It's wild. It's 7 years ago.
Yeah, and they've been very successful, Avantis. We talk a little bit about this with Edoardo. But they were a startup in 2019, and they've just crossed 50 billion in assets under management, which is pretty incredible for a startup. They're not a complete startup because they built themselves on top of an existing fund provider, so they became like the quantitative arm of an existing fund provider. But in any case, reaching 50 billion is absolutely incredible. So I think it's a testament to the products they've created and the success that they've had in marketing and telling that story. People will remember from last time Eduardo was on, he's got a PhD in aeronautics from the California Institute of Technology, literally a rocket scientist, which we actually talked to him about last time he was on, about the kind of parallels between aeronautics and finance. That was a really interesting part of that discussion. So the reason that this kicked off is that they're launching products in Europe. So I've been chatting to them about that, and that's what we decided it would be interesting to talk about. And we have a ton of European listeners to our podcast, and the Rational Reminder community has a large contingent of European contributors. So this is interesting for all of them. Avantis launching there will give them access to the strategies that we often talk about on the podcast in a way that they don't currently have. So that's all very exciting. But then we also talked to Eduardo about a few other interesting topics related to their products. I thought it was a pretty good discussion.
Okay, with that, let's go to our conversation with Eduardo Repetto.
Eduardo Repetto, welcome back to the Rational Reminder podcast.
Thank you, Ben. It's always a pleasure. Cameron, Mark, it's amazing to be here.
Yeah, great to see you again.
It is always a pleasure. All right, so to kick it off, Eduardo, can you talk about what sets Avantis apart from other asset managers?
That's a tough question because, in my view, every manager is different from any other manager. Not two managers are the same. So you say, well, Eduardo, what about index funds? How many managers manage the S&P 500? And you may have a point there, because in general, when you have index funds, they have not only the same strategy, but also they have the same fee. Not always the same fee, but sometimes they have different services. So every manager is different from every other manager. Now, the way I think about Avantis when we started, and we spoke about this before, is that our goal is to systematize active management. And what do I mean by that? So you, Ben, are too young, but Cameron may remember something called typewriters. Remember typewriters?
I took typing class in college, Eduardo.
Both of us. I took it in high school, so that's telling you, and it was quite bad. But I remember the typewriters that you have to move it in, not even the electric ones. And so, you don't know, Ben, about typewriting because Word came to systematize typing. Typing was terrible thing, for efficiency, and Word just replaced it. So we set up Avantis to systematize active management because active management is a very expensive proposition. You need a lot of people, analysts, portfolio managers to analyze a lot of securities to try to come with a discount rate and then to come to the target price. And that process is very, very inefficient from the point of view of cost, what basically prevents having the right level of diversification. So if you are able to analyze more securities at a lower cost, you can provide value added, and you can provide diversification, and you can provide all that at low cost. And that's what we were set up to do. And that's why we think about this valuation framework, to think about all the valuation of the company, and then you can decompose in pieces, but put it back together. And that's what we set up to do. I'm sure, look, there are so many managers. When we came to the world, the name Avantis, we were looking for names, and they were every name that you come to mind was already taken. So there are so many managers around the world. I haven't run anyone that thinks and the same as us and provides services the same as us. I cannot tell you that there are none. But we try to think about the company holistically, try to think about trying to find what companies are trading in the market with a higher discount rate, and why some companies have higher discount rates, because there is no axioma, law of physics, law of God, universal constant that says every company will have the same discount rate. So companies will have different discount rates. And so the moment that you have different discount rates, some company will have higher returns than others, and that's what we're set up to capture. And so that's what's different. So we, as you know, because we spoke before, we were set up to have if we were a restaurant, we would be a restaurant with great food, great service, and good prices. And if we're an asset manager, we want great investment strategies, great service, and good expense ratios. And that's, I think, that is a recipe for success for restaurants and also for asset managers. So that's how I think. Yeah.
Yeah, it makes sense. That reminds me of your gas station sushi comment from last time, which became a bit of a meme within our podcast community.
Gas station sushi. So I don't remember if I was in Tennessee or where, and someone told me there is a gas station here that has excellent sushi. I haven't tried, but it has excellent sushi. And I have to believe. I'm sure there is an exception on that, and some amazing sushi chef decided to have also a gas station. But yeah, that's a classic nowadays.
Yeah, yeah.
Eduardo, what strategies are you guys launching in Europe?
Yeah, that's a good question. So we did after our talk last time that we spoke, we started getting a lot of ping from all around the world. People asking us from not only from the US where we are based, but people asking us from Canada, from Latin America, from Europe, from Asia, and so we keep track of how many pings we get from people from all around the world, and even more, we got business, a sub-advisory business from someone that heard you guys in a conversation with us. So thank you. So when you get a lot of prospects, let's say, or possibilities to in different parts of the world, at some point you have to pay attention. And you say, why you didn't do before? Well, we're starting. We are, I think, yesterday, we are 4 years and 10 months since we launched the first product. So we're starting, but the goal is to service as many clients all around the world as possible. And so what we plan to launch is 3 UCITS, equity UCITS, and to service people around the world. And we have filed with the Central Bank of Ireland, because these are going to be Irish-based UCITS, small Irish-based ETFs, in order to have the tax advantage that the Irish-based UCITS have relative to other UCITS offers. And so we are in the kind of quiet period, let's call it, but we have filed, and we have hopefully going to come to market soon when the Irish Central Bank approves us.
Can you quickly, Eduardo, talk about what UCITS means? Like people in Europe will know what that means, but our non-European listeners might not.
Oh, yeah. So in the United States, the funds are organized under the 40 Act. So and so we have, when you speak about a mutual fund or an ETF, in general, that not always, but in general, 40 Act vehicles, and that's a regulation that under which a mutual fund or an ETF is structured. UCITS is similar, but basically for Europe. It's an undertaking of collective. It has a long name, but basically it's a regulation under which the funds or ETF are organized in Europe, and Europe is a whole set of countries. So you can make them based in different countries, and they can be used in the other countries if you have the right regulatory filings and papers. One of the benefits that UCITS have is that they have become global funds. So many investors from around the world, say Asia or Latin America, or offshore money, not only Europe, use UCITS because some of the UCITS, depending where they're based, have advantages related to double taxation. Like, for example, if you are a foreign investor and you buy a US fund, when the fund makes a distribution, the US keeps 30% or whatever it is in withholding taxes on that distributions. UCITS in certain jurisdictions and not to have this double taxation problem. So that's why they have become a very popular global investment vehicle. So
Okay.
that's what UCITS mean.
Okay, got it. You mentioned that there are 5 strategies you guys are launching. What are the 5 strategies?
I say 3. So
Oh, three.
the plan. So we have filed for approval from the Central Bank of Ireland,
Okay.
and hopefully we get it soon. We hope so. So we plan to launch 3 strategies, but our plan is to over time enhance our family. So in the US, if you remember, we started our first ETF was emerging markets. One week later, we launched 4 other ETFs, and today we have 28 and 2 more to come. So you have to start somewhere. So the strategies that we're planning to have are basically strategies similar to the strategies that we have in the US. So we're planning to have an emerging markets strategy. We're planning to have an global equities strategy. We're planning to have a small value strategy, global small value strategy. We plan to have all these things in all the different markets that we go. Let's suppose we start in Canada tomorrow. Probably that's a good idea of what we plan to do in Canada. And probably if we do it, no, and I'm not promising anything, but we also having a local equities strategy. That's basically what. If you put yourself in our shoes, that's probably how you will start, because those are basically why we are known. Yeah.
Yep.
So Eduardo, can you talk about how aggressive are the factor tilts in the UCITS global equity strategy?
So if you're speaking about the strategy, our global equities strategies, you know our US strategy. So let's speak about the US strategy because it's easier. So if you look at our US strategy, what we are always trying to do is emphasizing securities that, in our opinion, are trading at a higher discount rate. Securities have low price relative to the equity and the cash flows that they have. In banks, we say, well, securities with high profitability and high modifier or book to price. Yeah. So in particular in small caps and mid caps, where the premiums are higher because the dispersion of valuations is higher. So our idea when we launch these global strategies is to follow what we have done in the US. So in the US, you have ADUS, ABBE. So you know these 2 tickers. They are our US equities, our international equities. That gives you more or less an idea what we will do in any market that will launch a global equity strategy. And but it's global, so you have to deal with weighting US and international. But you know that when we select securities, we do country by country. So putting strategies that are multi-country is just basically is using the security selection and weighting that we do in a country, another country, and then stitching them together using what we do in general is market weights.
Okay, yes, that's one of the questions that I had, or it's related to it. For the global small caps value strategy that you mentioned, what does the geographic exposure look like?
Okay, that's what we're speaking about. But and this is a good question. Let's divert a little bit. So if you speak about the global market is around 60. I'm speaking about ex-emerging markets, because when we say global, we are not including emerging markets. Emerging markets we put apart, and you can tell me why is that? Because many investors really don't want to have emerging markets. So if you allow that having emerging markets apart, you basically can have someone invest in developed market. They want emerging market, they can add it. Subtract it is impossible. No. So if you think about the developed markets, let's say, or what we call global markets, the US is around 70%. International developed is non-US developed is 30%. When you look at the small caps, this is very interesting, Ben, because if you look at the small caps, FTSE, Morningstar, S&P, they are basically 70-30. Yeah. But when you look at MSCI is 60-40. And that's because MSCI methodology puts a cap in the maximum market capitalization that you can buy in any country. And so the US has an artificially small representation in MSCI small caps relative to the other benchmarks. So that's why MSCI has 60 instead of 70. So our view for global markets, no matter if it's large cap or small caps, it's probably that we follow the 70-30.
Yeah, really interesting.
In certain cases, we have not done that, but but we like to follow this in general. Unless you have one country specific that the people really are attached to MSCI, we follow the 70-30.
So beyond some of those differences and beyond it being a UCITS, is there any major difference between the strategies that you're going to be using in Europe versus the ETFs that you launched in the US market?
Well, the answer is we have our strategies and we need to accommodate our strategies to the different regulatory environments. So if we have to apply UCITS, there may be a slightly different regulation than the US. So we have to adapt to the European regulatory framework, like the same like we do in Australia, we do in Canada, or whatever we launch a strategy, we have to adapt to the regulatory framework. But the strategies are the same. We manage the strategies in the same way, with the same people, with the same philosophy, with very similar process. Caveat is this regulatory difference that you may have here and there. And so, no, you know our stripes. We don't change our stripes because we're in different market. We only will change things when there is a particular need in a particular market. So let's assume, for example, in certain markets, for example, if you go to Australia, they have franking credits. So there you may have to accommodate franking credits for Australia different than if you are running a typical global strategy investing in Australia. In this case that we're speaking about, I think it's you can think about this as the same as what we are doing in the US.
Great, thanks.
Now, one more thing. So one thing that happens in Europe that is interesting, and this is different than the US, in particular for ETFs, and funds are different. So when you have a UCITS fund and people want to access that UCITS fund in different currencies, you have to have different share classes in different currencies. Yeah. When you have a UCITS ETF, that's not the case. Because you look at UCITS ETF, there may be listing, you may have for the same fund listings in different countries, in different currencies. So you see UCITS fund that the NAV may be in USD, but listing in Europe, in Germany, for example, or in Netherlands is in euro, and the list, or in Italy is in euro, and the listing in the UK maybe in GBP and USD, and the listing in Switzerland may be in Swiss francs. So that's different from the US. People can access in whatever currency is more convenient for them, depending on the listings. So in UCITS in general, you have several listings to provide easier access.
Yeah, that is interesting. One of the things that people worry about with new ETF launches is that they won't survive and that they'll have to close down and maybe there'll be a taxable disposition. Do you have a sense of how much AUM these new strategies will have to reach for them to remain open in the long run?
So I tell you how we think about this in general. So and we have that. You can imagine how many times we have to answer that question. We're not answering that question anymore, but we were answering that question day in, day out. And so you have to plan that before going to market. You are not going to market. Imagine going to market in any market is a big expense for anyone. So you have to have some level of confidence that things are going to be okay. And remember the restaurant. You have a good restaurant that has great food. You have a great chef, great staff. You have good food, good price, good service. Things will work okay. It may take a little bit longer or a little bit shorter. So I don't think about one fund in isolation. I think the whole offering when you go to any particular place together. Some funds maybe have a little bit more, some funds may have a little bit less, but you think about the whole offering And so once you commit to go there and you have the right strategy, you have the right pricing, you have the right service, you have to go and just fight the battles. And if you have the right price, things will happen. You will be able to survive. You will be able to thrive. And if you charge too much, the answer is probably you're going to suffer. If you have bad strategies, probably you're going to suffer. You have bad service and people don't know about you, probably you will suffer. But whenever you just put an offering in the market, you have to take into account all these different aspects. And then just go and do your homework. Just go and knock at the doors, go and speak with people, and things will happen. So I would not be too worried if I were someone thinking about this question about will they come in today and then will they go out tomorrow? And the best example is what we have done in the US. We have been able to start from scratch, grow it from nothing to now it's around $50 billion. Just expand the offering, and anywhere we go, we do the same because that's the right thing to do, and that's the right thing to help people that trust you on day one.
And related to that $50 billion milestone and Ben's question, with AVUV, for example, at 12 billion or so of AUM, at what point do you start to worry about strategy capacity, or do you even worry about that?
That's an amazing question because, and that's where you started thinking about ETF versus funds versus SMAs or separate institutional separate accounts.
Yep.
So capacity, it's basically your inability to invest. And there are two parts of capacity. One is how much you own of the company. If you need to own 80% of the company to invest money, well, they have a problem. You are owning the company at that point. You're not an investor. You are the owner. No? You're a controlling shareholder. But forget about that part of capacity. That's a big number. So, but the more common capacity part is your inability to invest cash flows. Yeah. So you are giving me so much money. My fund is so hot that I'm getting buckets and buckets of cash. And when I go to trade, I'm having problems investing that cash in a reasonable time at a reasonable cost.
Right.
Yeah. So then I have to equitize the cash, and if I have a small cap strategy, I have to equitize with S&P futures that are not really the strategy, but have a lot of other issues, and it becomes the typical capacity issue. And what people do, then the portfolio start being less focused, or the portfolio changes strategy, or you just incur higher trading costs. What is a problem at the end of the day for the initial investor that have to deal with that. So ETF are a little bit different. Why? Because in ETF we don't get cash, we get securities. So whenever we manage ETF and you buy our ETF, if the market maker needs to create ETF shares to settle the transaction with you, they have to do it by speaking with us and say, hey, I want to create ETF shares. So say, okay, give me these securities and I give you ETF shares. That's the income creation process. And so we are not having cash drag because of cash flows, because we get the securities that we want. When we manage ETF, we have two baskets, a creation basket and a redemption basket. So each time that the market maker want to create ETF shares, because there are purchases that they have to settle, they have to give us securities in our creation basket. And you can imagine that the creation basket is the securities that we want today. What we say, what is the new securities that we need to increase weight and we need to add to the portfolio. And when there is a redemption, what do we deliver? We deliver the redemption basket. And you can imagine that redemption basket is a securities which we really don't want so much in the portfolio anymore, that they have already served their purpose and it's time to let them go. So this dual basket process where you have income creations and redemptions basically help you rebalance the portfolio. It's like basically outsourcing the trading, because you receive the securities. You don't have to pay for commission. You don't have a market impact because you're not trading. You're receiving the securities. So capacity gets extremely alleviated when you're managing ETF with this in-kind redemption and purchase processes, creation and redemption baskets. So our strategies have a lot of securities, a small value, speaking, has like 750 names. So that spreads the allocation and the amount of trade that you need in any particular name. Our strategies are low turnover, so that minimizes the amounts of trading that you have. And our strategy, ABU in particular, is an ETF. So a lot of the trading doesn't happen by us trading. Right. Most of the trading happen by in-kind processes. So that gives you a humongous amount of capacity.
That's interesting.
It's amazing. Look, you start thinking about ETF versus funds or separate accounts, and you see the benefit that ETF. There is a reason why ETF are growing so much. It's the benefit that this structure brings to an investor is quite impressive.
Yeah, even here, there's some big fund companies that are rolling out ETF versions of their mutual funds. So it's a trend here as well.
But what is interesting, a lot of people are speaking about creating share classes. So you have a fund and you create a share class of the fund that is an ETF. And I'm not a big believer in that. Why? Because if I have an ETF, I'm whenever I buy and sell, I want to be sure that no one else comes in cash and impose costs on me. So if you give me the ability to have a fund, I'm an investor now, and I can buy an ETF that is standalone or an ETF that is a share class of a fund, everything equal, I always pick the ETF as a standalone. Why? Because if I'm buying the ETF that is a share class of a fund, I'm exposed to cash flows in and out from people coming in the fund share class that are coming in cash and they're going in cash. In the ETF, I don't have that issue. I'm completely isolated. So yes, a lot of people are trying, at least in the US, I don't know, in Canada, are trying to bring this share class. It's not fully approved yet, but they're trying to bring share class, ETF share classes attached to their existing funds, basically to save their funds. I don't think that, I prefer to have ETF alone. That's why, if we have the same strategies standalone, fund and ETF. So you want a fund for whatever reason you want a fund. Maybe you are a 401k, you have no choice by having a fund. Okay, we have a fund. You want an ETF, you have an ETF. We try not to give you the cocktail and the dessert mix. We try to give them both of them so you can decide which one is best for you.
Great. What are you hearing from the advisor community or the investment community at large about why they're allocating to your strategies?
Yeah, you can imagine it's such a diverse group of people. So there are many different stories why. Some people do it because they love our strategies, and I imagine that's a lot, and they also the pricing. Some people do it because they want manager diversification. They want to have, one more manager that is really good. That allows me to diversify my managers. So that's another reason. There are different people that do it for different reasons. Well, performance has been quite good, the numbers. Our fees are low, our service is good. That we produce this thing that called the field guide that comes on the third business day of the month that is broadly used by the advisor community. And so I think that we provide good products, a good service at a very attractive fee. And so I always think about the restaurant, it's the same. So if you have these three things together, people sooner or later will realize it's worth doing business with these guys. Early on, people can say, well, I don't know if they will survive, or let's see what happens, or let's get more track record. But the more that the time passes and the strategies prove themselves and the service proves itself, and people realize, this is good for my clients. And, advisors are extremely good fiduciaries. They love to find solutions that will improve their client's portfolio. They will improve the outcomes for the clients. And I think we came to market with an idea that we could provide a state-of-the-art solution with a state-of-the-art client service and a very attractive price. And people have embraced that. And we strive to keep on doing that and even better every day.
Do you have
You tell me, what you're an advisor. You have a lot of experience as an advisor. So you tell me, why will you use someone like us?
I think you touched on a lot of the right points. You guys aren't in Canada, obviously, so it's not something that we've had to seriously consider
Yet.
But from other advisors that I've talked to, I mean, manager diversification for sure. You guys did come in with a nice product at a lower fee than some of your direct competition. So those have all been meaningful. And then, like you said, I mean, you launched at a time when performance ended up being pretty good after the launch, and I think that always helps.
Yeah, that helps. But I think if you look at long term, it's more than just a time in luck. I think it is in long term. I think we're well positioned. So
I agree.
Sorry, I interrupted you.
Do you have any sense, Eduardo, of your client breakdown, like advisors versus individual investors or DIYers? Can you tell?
Most of the money is advisors or wealth management money. We also have institutional money. We also have some advisory business with a lot of insurance companies. And you're asking me basically how much you have in retail clients. And the answer is I cannot be completely sure.
Right.
It's quite difficult for a retail client to find us, unless if it's someone that is very knowledgeable. Like I'm sure that a lot of people listen to your podcast or reading some particular technical, because we don't technical publication, but we don't do advertising. You're not going to go and see the Dodgers, Avantis or whatever, and we don't have in Forbes or in Wall Street Journal, a page with look at all my Morningstar stars or anything. So we are not targeting retail clients. It's not our business. We like to speak with people that are knowledgeable. And there is a lot of retail clients that are knowledgeable, but it's very difficult for us to know who. So by working with intermediaries like institutional consultants or officers of institutions or professionals in insurance companies that or other asset managers that we are sub-advisor or advisors or wealth managers in general, we're speaking with people that are knowledgeable, and we can explain what we do, and they learn what we do, and then they learn how to use that in their asset allocation. So we feel way more comfortable with that.
Yeah, that's interesting. That'll make people listening to the podcast feel very special because, like you said, many of our listeners are retail investors who are using Avantis products. They'll feel like they've got a secret.
So look, Ben, I all of us are kind of geeks, no? At the end of the day, if we listen to the Rational Reminder, even the name, the Rational Reminder, all of us are kind of geeks in this field, and that's okay, It's a very nice to create a community like the communities that you guys have created, where people that have a common interest can listen, participate, learn, debate, and it's impressive what you guys have done.
Thanks, Eduardo. Since the last time you were on Rational Reminder, you guys have actually launched an emerging markets small cap strategy, which is something you didn't have last time. One of the questions we got from the Rational Reminder community is there potential for an emerging markets small cap value strategy in the future?
That's a great question, and we thought about that. And what we did is something slightly different. We have a strategy that we call emerging markets value. Yeah. So, and that emerging market value strategy is not a market-wide strategy. It's not get all the value stock from mega caps to small caps. What we do is we exclude mega caps. The largest mega caps are not part of that strategy. So you can think about that strategy as a small mid. Maybe it's a little bit larger than a small mid, depending how you define mega caps. But it doesn't have the largest mega caps. So that was our solution for a small value strategy. So let me give you an idea. So if you look at a market-wide strategy in value, the allocation to large caps, to the largest cap, is around 40%. So
Mm.
call it large and mega caps. Then you have mid caps, and then you have small caps. It's like 40%. It's a big number. Our allocation is much smaller to those companies. So our weighted average, our geometric market capitalization on that in emerging markets value is around 6.5 billion. And this is Morningstar data. Anyone can check it. And if you look at MSCI emerging markets, the geometric market capitalization is 28 billion. So we're way smaller if you think about market capitalization. Now, there are smaller market cap solutions than us in emerging markets. Others provide smaller than 6.5 billion geometric market capitalization. But our view is that once you get out of mega caps and you get into mid caps and smaller caps, and if you consider the full valuation framework trying to buy companies that despite the high profitability, they're trading at attractive pricing, you have a nice universe of companies with nice valuation spreads, and you can provide good value added. And so I think we do something for people that are asking about emerging markets or small value. I think what we have may satisfy their need. It's not as small, I understand, but I think it may satisfy their need.
Yep, makes sense.
Since you guys launched in 2019, have there been any enhancements or improvements to the way you guys implement portfolios at Avantis?
Okay, so the lucky thing is we didn't have to make any big changes, because if you have many big changes, maybe because we screw up in something. So there have not been any big changes, but there has been a small improvements here and there. Some of the improvements are on processes. Like I remember that I told you dual baskets. At the beginning, we were not working with dual basket creation. We were working with one basket. Soon later, we could start working with dual baskets. So we start moving to one basket. That's it. Operationally, that's a big improvement. It's cumbersome, but it's a big improvement because it allows you to much better rebalance the portfolio at lower cost. So then they have another changes imposed on us because of changing reporting. So reporting in whatever country, financial reporting is changing in whatever country. So now we have to adapt and find the new variables that are going to work on the way we want. So there have been small changes here and there. We have looked at a lot of things. So like, for example, instead of using the cash profitability, at some point we were looking at free cash flows. Yeah. And we found out that it didn't work as well as cash profitability, at least our version of cash profitability. And the difference between free cash flows, the main difference, not the only difference, but the main difference between free cash flows and cash profitability is CapEx, capital expenses. And if you start thinking why it doesn't work as well, is because in capital expenses, the manager, so the company, has quite a lot of discretion when they make it, how they make it, and can make all the CapEx for this year, for the next 3 years, or they can spread it out. So the numbers become less comparable. And one of the things that we learned from Robert Mark's paper is going up in income statement, you make numbers more comparable, and being able to compare apples and apples is better than compare apples and oranges or pears or whatever is as close. And so free cash flow didn't work as well. And imagine that you have two companies, so Ben and Cameron's company. And Ben's company and Cameron's company, they're great businesses, but Ben doesn't make any money, so doesn't produce any cash flow. So he doesn't make any capital expense. So his free cash flow is low. Cameron makes a humongous amount of money. So he's bullish in his business. He makes a big capital expense. So his free cash flow is low. So the two businesses are very, very different, but they have similar free cash flows, while the cash from operations is very, very different. So that gives you an idea why we found that it didn't work very well. So we play with a lot of things, trying to improve our metrics. Pitifully, or luckily, depending how you think, we haven't found yet something that is a big enough change to publicize. But there have been small changes here and there.
What's the most exciting research you guys are looking at implementing now?
So we're working on the other side of the spectrum. we're on the value side. We're working on the growth side, and we think we may have something interesting on the growth side. But we'll see. We will come. We'll make some noise at some point. So we think we can have something interesting on the growth side. So that's interesting. But in general, we're always looking how to improve our proxies for the equity of the companies, our proxies for the cash flows of the company, or how we can improve efficiencies in our process, like I told you, the dual bucket or other things that we have been applying in order to minimize costs of every kind. And ETF allows you to do a lot of improvements in the operations that, it's savings pennies or sub pennies here and there, but then everything adds up. So we are also working on that. But, we will make more noise when we find something. But we're working on the growth side of the market. We think that there is room there to do some interesting things.
Yeah. We noticed the prospectus you filed. I want to come back to that in a minute. We had Wei Dai from Dimensional on recently, and she talked about the cool thing that they're looking at right now is short-term reversals in their investment process. Is that something that you guys are looking at or will look at?
Well, we look at short-term reversals. Even when I was there, it's there. There is some. It's a bit controversial, depending who you ask. I'm sure you ask some of the fishing market academics, we don't name it, they will tell you, it's bid as a spread, or bounce back. Way is great. Look, let me be clear. I cannot say more great things about Way. Way is great. It's a pleasure as a person, but it's also a very knowledgeable person. Now, what is reversals? Yeah. A reversals is basically, it's a very high turnover strategy because it's the performance of a company over a short period of time. It can be a week, can be 3 weeks, it can be a month. So companies have the best performance over that very short period of time. The expectation is they have a reverse. They have bad performance in the next short period of time. So that's short-term reversals. So it's extremely high turnover strategy. Yeah. Now, our strategies. Our strategy are extremely low turnover. So if you look at our market-wide strategy, you are speaking about single digits or low, very, very low double digits in 10 to 15% at most. It's not expected to have more. Even if you look at our value strategy, turnover is around 20, 25% on expectation. Yeah. So we have low turnover. So when you have, let's call it a signal that give you information on a very high frequency basis, and you are trying to apply to something that really doesn't move, you really don't have a lot of value added. It's just a statistical noise when it comes to value added at the strategy level. So we know reversal. We have looked at reversal. We knew it. I knew it before this Avantis experience. We knew that before. And so, but for our kind of strategies that are so diversified and so low turnover, really, that they don't make any sense.
Interesting.
No, it's just a statistical noise. Let's put it that way at best.
So you mentioned earlier that there's some interesting things that can be done in the growth investing space, and Avantis recently filed a prospectus for a U.S. growth equity ETF. So I'm curious, what is it that you think that's interesting that can be done in the growth space? And then also, how do you think investors should think about allocating between growth and value?
Yeah, that's a great question. So, and still we haven't settled on the name. Maybe we change the name, but on the growth space, one of the big things. So if you think about our valuation, we are using today's profits as a proxy for future profits. Can you improve that proxy? Can you improve the proxy? Can you have something better to say about not level, but changes in level? And the answer is maybe. And so that's basically the angle that we are playing with. And you can call growth, or you can call quality, or there's many ways to name these things, and we haven't. Some people may say this is more quality than that growth, but it's all related. So that's basically the angle that we're playing with. And so when we come to market, we probably tell more about this. And the second part of your question is interesting. What you think about how much an investor should buy value or versus growth, or should they even buy growth? And the answer, I think, it was given by Markowitz, not by me, so I cannot take credit. So Markowitz said, hey, when you're forming a portfolio, expected returns alone is not the answer. You should consider expected returns and risk. And so there is a trade-off there, because if you just care about expected returns, you finish with one security in your portfolio, the one that you think has the highest expected return ever. And so I think there is a role for growth, for value, for large, for small, for diversification in the portfolio. That doesn't mean that we cannot deviate from the market, overweight in some securities, because we have, we think that the opportunity that those securities provide us is better than others. So we can deviate from the market, overweight in value securities, and underweight in growth securities if we think that value securities have higher expected returns than growth securities. And when we manage a portfolio like AVUS, we have growth securities, we have value securities, we have large cap securities, we have mid cap securities, we have small cap securities, but we deviate from market weights. So growth or a quality or a strategy plays a role in someone's portfolio. It may not be a market weight, it may be below market weight, but it plays a role in some portfolio. If we can create a strategy that is growth or quality with higher expected returns, it certainly will play a better role than a security that has lower expected returns, that certainly would be more underweighted. But all this plays a role when you're thinking about the trade-off between expected returns and diversification.
Yeah, really interesting. I think Novi Marx he talks about it as good growth in one of his papers.
Robert is a clever guy. I saw Robert like 1 month ago, 2 months ago, after so many years I'm not seeing. We were in an event and we had dinner together with other people at the table. It was such a pleasure.
Oh, I bet it was.
Yeah. So I always remember that Robert used to like old fashions with very little or no sugar. But then he changed his drink. So I said, Robert, what happened? You changed your drink. And so it was fun. It was great to catch up.
That's great. For funds like AVGE, which is like a single ticket asset allocation fund, how are decisions made about asset allocation? And just for example, one of the questions that we got from listeners is, if they like the current factor tilts in that portfolio, should they be concerned at all that they will change over time, maybe get more aggressive or less aggressive with the tilts?
That's a good concern, because you are outsourcing the asset allocation to us. Right. But I don't think that it's a good concern, but I don't think they should be concerned, because our strategies are not high turnover. Yeah. So I would not expect any dramatic change in our tilting or allocations in our strategy. People that have views about their abilities to predict the future do changes. We don't do these changes. So our call it tilts should be quite stable. It should be quite stable, unless there is a new discovery. It should be very, very stable. We tend to have low turnover strategies and whatnot. What it may change, for example, is country weights. You know that the US now is a bigger fraction of the world. When I started, the US was a smaller fraction of the world. So, but the same as Australia may be a bigger fraction of the world, and Italy may be a lower. So you don't see, but those things are happening. So these allocations across countries, they are low turnover allocations, but they are moving slightly here and there. But the tilts towards the premiums that we're trying to deliver, to the higher discount rates that we're having, I would not expect that any dramatic change, unless there is some discovery that will be, worth speaking broadly.
Makes sense.
Eduardo, is there any hope for us Canadians that you guys are going to launch some ETFs for us here?
I hope so. We are expanding. So I hope so. Canada, I love going to Canada because Canadians think that I have an accent. They also think that Americans have an accent. So it's more level playing field for me. I remember being in conference and say, "Oh, well, it's like you have an accent the same as the other guys." So I love that. So I love going to Canada. So yeah, no, we're seriously considering. We know that we have Canadian investors in our ETF. We know that not because we're selling to Canada, we can't, but we know that because we look at custody records, and given we infer from the custody records that this money coming from Canadian investors, though we don't know who. And I think that for retirement monies, and you guys will know more than me, for retirement monies in Canada, US-based ETFs provide a very, very competitive product. In particular, the US-based ETF that invests in US securities, because you don't suffer withholding taxes. Right. And so I think that's where the money is coming. Advisors that are very, very clever, and they say, or retail investors that are very knowledgeable, that listens to you guys or someone like that, that say, I am not suffering withholding taxes by buying the US ETF versus buying the Canadian version of the ETF. So there you go. I buy these guys in the US. But yes, we have been looking into Canada. It's a new market. You need not only the ETF or the products, but you need all the infrastructure to support from the marketing point of view, the servicing point of view. You cannot say I have a great chef and they prove good meal, but the service sucks, and I don't have dishes, not napkins, and not forks and knives. You have to have the whole offering. So we have been looking into that. I really hope we can get into Canada because there are so many places that are worth visiting in Canada. I love going there.
Love it. Great. Love to hear it. All right, Eduardo, this has been great. We really appreciate you coming back on. It's great to see you.
It's always a pleasure. Thank you very much. And thank you for all what you do for all the investors all around the world. Yeah.
Thanks, Eduardo. Great to see you again.
Bye.
Thanks, Eduardo.
That was fun. As to the after show for the three of us, which I must laugh. There's so many people. I know it's now more than three. It's probably up to 5 people that listen, and they're pretty active on Twitter about it. I'm pretty proud to be here. So it's our private little club.
Yeah, there's always a joke on Twitter about it afterwards.
It's always a joke.
Yeah, John Stocking, I think, is our biggest Aftershow fan. He talks about it quite a bit, a little bit too much. It's kind of weird, John. Lay off.
Well, it's basically based on some reviews. Ben and the mids, right, Mark?
That's right.
Ben and the mids.
It's so funny because I've been playing a lot of my wife's away right now. She took the kids to Mexico for an extended vacation, and just happened to be a good time, right? Like kids off school. It's summertime. My wife's not working right now. Just thought it'd be a great time for her to go and take the kids. So I've been playing a lot of guitar. So these guitars on my wall are not just for show people. I actually play, or I have been at least this week. And I was driving home the other day, and I was like, I should start a band. And then I was thinking about names for it, and the first name that popped into my head was Mark and the Mids.
So we hadn't even talked about that. So he came to me too.
Yeah, and I just think it's a pretty catchy name. But it also means that I'm not mid, right? I'm Mark. The other guys are mid, so it's kind of works in my favor as well. So,
exactly.
Album coming soon.
So before we talk small cap, it just kind of ties in with the mids. Let's read the recent review. Is that okay with you guys?
Yeah, who's going to read it?
So this came from, I'll read it. So it came from 3 year long from the United States. Ben Felix. You heard it here first. Ben Felix is a global treasure, Mark.
Can we get Ben to read this?
Actually, that's not even a better idea. Ben, you read it. How's that?
Come on.
I just want to see him squirm.
Ben Felix is a global treasure.
Stop. Just pause. Let that sink in. Just appreciate it, Ben.
This is the only podcast that gives honest, real, analyzed financial information with a gentle dazzle of subtle dad humor. It truly is gold. Ben Felix is at the top of my and my husband's top hottest celebrity list. No one else has the courage to be this detailed and boring. It's a so good. Very unique review.
That was great.
That was
great. I had a good laugh when I read that.
Yeah. Ben and the mids.
Yeah, so anyway, small cap value.
Let's get back to your happy place.
It's done really well recently. I think it was like a record 5-day run, like a historical record,
Really?
at least for the Russell 2000. I just looked at the month-to-date return as of July 17th for AVUV, the Avantis U.S. Small Cap Value ETF. It's up month-to-date, so July 17th, 8.85%, which is pretty incredible.
Isn't small growth also doing well? Not just
I
the
did
value
not
side,
look.
right? I saw someone
didn't
posted
look at
that.
it.
Small growth is doing pretty well.
Yeah.
Also, yeah. Over the past, I just looked at the Morningstar style boxes yesterday for the past month, and both small U.S. small value and U.S. small growth were up about 10% over the month.
Sorry, Ben.
Not too bad. Over that same period, so month to date, July 17th, VTI, just the Vanguard U.S. Total Market ETF, is up 2.82%. So very significant month to date premium. Now it's still trailing year to date. Like U.S. large growth has been insane this year, so small value still has some catching up to do. But that short burst of positive returns from small value, and even in excess of large growth, is always a reminder about the importance of staying in your seat if you want to capture risk premiums. And maybe think of actually, Mark, you reminded me of this with the chart. Back in episode 147, we had Paul Merriman on. He talked about his I don't know if it's his actually. Might have been Bogle's chart originally. Anyway, he talked about the telltale chart comparing U.S. small cap value returns to S&P 500 returns. It's kind of a neat chart that shows the relative performance of small cap value relative to the S&P 500. But what it basically shows visually is that small cap value going back to 1930, which is when the chart starts, has tended to have really long periods where it underperforms the S&P 500, and then relatively short bursts of outperformance. But like on average, in the long run, small value outperforms, but it tends to happen in these short bursts. And and then there are these long periods where you've got to kind of stay in your seat if you want to capture those. So like as a long-term investor, you end up being better off in small cap value eventually, but getting there requires enduring those periods of relative underperformance compared to something like the S&P 500. And I pulled a quote from Paul back in that episode. He said, "How many people are going to be able to stay the course when for 13 years, and there have been longer periods of underperformance, but when for 13 years, their neighbor is bragging about how much money they're making in the S&P 500. That's what they're going to have to put up with." And that's like
Now.
Yeah.
Hasn't changed. It's just as true as it was when Paul said that to us back in 2021. But anyway, this recent like historic small value or small cap in general performance is just a good reminder that those returns tend to show up in short bursts, and you got to be there if you want to capture them. I did also want to mention though that so year to date U.S. small cap value is underperforming market. In Canada though, small value is doing quite well year to date. So I looked at just year to date as of July 17th again. DFA Canadian Vector, which is a small cap value tilted Canadian equity strategy from Dimensional, it's up 13.91%. And then the Vanguard FTSE Canada All Cap ETF, just a market cap weighted Canadian ETF, is up 10.99%. So it's a pretty meaningful, and that's the Vector is not even a small cap value fund. It's just a more aggressively tilted toward small cap and value, but it's still sort of a more like a total market with aggressive tilts than it is a small cap value strategy. Anyway, so it's done quite well year to date. Even over the last 3 years, it's outperformed. Yep, so there it is, small cap value. It's back.
Patience is rewarded. Did you see the? There's somebody I follow on Twitter. He goes by Jake, and his handle is Econompic. Like instead of economic, it's Econompic. Good follow, by the way. He puts out a lot of really interesting information. But he posted a chart this morning, and it's the 30-day correlation between the S&P market cap weighted benchmark versus the S&P equal weighted benchmark. So it's a rolling 30-day correlation matrix. And it's the lowest it's been since 2006. The correlation between an equal weighted portfolio and a market cap weighted portfolio is like in the neighborhood of 0.25 over the past 30 days. So the tweet was hilarious. He's like, you could have essentially diversified your S&P 500 market cap weighted risk with S&P 500 equal weight risk because they haven't been moving at all in tandem, right? And I think it just goes I mean, it's a corollary to the small cap underperformance. Had you weighted differently to small value or even small caps in general, the performance has been like incredibly different from large cap over the past 30 days.
Yeah, that is interesting.
Yeah.
So you want to talk about one of your new friends on Twitter, Mark?
Oh, yeah.
One of your many
So,
friends. You've got energy for that stuff that is beyond.
It fires me up. I don't know. Like, I think social media, like we know from looking at studies on this, that people turn to social media for advice. And there are a lot of finfluencers, if you want to call them that, putting out advice. And there's lots of good ones that have, reasonable advice, but there's a lot of really, really bad ones. And so I saw a post from somebody saying, like, why would you ever leave $100,000 in cash? Didn't you know you can generate 1% per week selling stock options on that? It's like 1% per, come on. Okay, so if you compound your money, yeah, well, of course it's compelling. It's because because it works out to a 68% annualized compound return. And so I just like quickly pull up a compound interest calculator, and I think I worked it out. It would take you 43 years, starting at $100,000, to own all of the wealth on the planet. Like if you had that kind of compounding return for 43 years, starting with $100,000, you'd end up with $420 trillion in your back pocket. So you would like completely consume all of the capital in the world after 43 years of these types of returns. So anyways, he was talking about option selling, and I happen to know a decent amount about option selling. And so what I've realized is a lot of these people talking about selling options for income are only considering half of their trade. And I won't get too deep into what I wrote about it. I think, Ben, you and I decided we might just do this in a separate episode coming up. But I wrote like a big rebuttal basically to why that is absolute nonsense. You shouldn't expect those types of returns. And it's funny, I had a couple small hedge fund managers that run option strategies reach out to me by direct message saying like, yeah, no, I've been doing this like systematically in a quantitative way for 18 years. And like, if we can get 20% consistently per year over a long period of time, like we are absolutely thrilled with that. So any amateur trader promising 1% weekly return selling options, you can just ignore them with prejudice.
That's kind of Rentec type returns.
Well, that's just, of course, that's the comparison they're going to make, right? If you say nobody can do it, they'll be like, well, somebody did. It's like, okay, but I don't think you're the next,
Rentec.
The next Rentec. So
Yeah.
and maybe you are.
I don't think they didn't do that selling options either, did they?
No, they did like 40 million trades a year, but I don't think they were selling options.
Cool.
Yep. We did an episode on covered calls a while ago, same kind of idea. I think we talked about a lot of the issues you cover in your thread.
Yeah. Yeah. The other strategy that people love is selling cash secured puts, which we'll get into in the episode because it can get fairly complex. But anyways, the tweet was just like a breakdown of how this works and why it's absurd to think that selling options can generate that type of return over the long run. It's not sustainable. And I tagged this individual saying, hey, like, here you go. Because when I commented on his post, he first said, sounds like you don't know how to sell options. I was like, well, okay, now I have to write a whole thing. And so I wrote the whole thing, and then I tagged him, and then he wrote back saying, sounds like you don't know how to sell options. I was like, dude, I just wrote 2,000 words on selling options. Like, what have you contributed here? So anyways, these Twitter spats. And I do it just because I think it's good for people to read that information, right? Like to kind of counter the misinformation that's out there. Not because
I agree.
I
I'm just saying, you
have
energy I don't have for that.
Yeah, your energy is impressive on that stuff.
No, it's exhausting though.
Anything else on your minds this week?
It's like the small cap value premium. It comes in fits and spurts, this type of energy.
All right. Anything else in your minds?
No, I
summer
think,
here, nice weather.
Yeah, I think we're good.
Okay. All good, Mark?
All good.
All right. Thanks everybody for listening once again.